Good afternoon, Scott Riley, T3 Live. Welcome to Tuesday's recap. So Big Ben started speaking at 10 o'clock on the Hill. He alluded to the fact that, everything that he's been saying for the past year as far as the economy slowing, his concerns over unemployment, the sluggish, numbers that have been coming out, the problems in Europe. And he didn't really say what he would be doing, if there's any QE3 or if it'll start in August or it'll start in September. And the market pretty much took that as a sign to sell. And we opened up above that. I think it was 135.89, came in lower, broke below yesterday's low, got some people to chase, to press, went even a little bit lower before finally turning around and then really just grinded up all day long. That type of move definitely knocked some people's teeth out. Anyone that stayed short or just rolled it up and said, I'm going to just, there's no more QE, we're up on anticipation of QE, there's no way we're going to rally, might be still short going into this close, and they're going to have a few decisions to make. For me, I started the day net short. I shorted Goldman Sachs, I shorted some Apple, I shorted some Spiders, and had a really good morning after Big Ben spoke into 10:30. Then I trailed some and I had to stop, and I still lost or gave back a lot of money, but at least I followed a set of rules where it was a level versus a level. If you go and look at the chart of the Spiders right here, you will see that before we get into this chart, I want to show you the 5-minute chart. All right, so basically, this is what took place on the open, which is definitely very hard to handle. Here is where we opened up into just say this gap. And then, this is, right around where we opened up, right around that 136.20, which matched, by the way, that the 130, that other high that we had right around here, right? This was 130. It's a few levels back, but I don't feel like getting into that. But anyway, this was, this is where it opened up. Then it started getting to the gap. So typically gaps get filled. So you have a nice little short setup. We came in. It paused right here. This is, I think, where I got pretty aggressive, where I added to my shorts, and then you had a nice move lower. Then all of a sudden, you had a nice little bear flag, right? So you opened up, here's your pull, here's your flag. I think I did add a little bit, through here as well. And then you had a nice, follow through Ben Bernanke's statement. I wrote up a nice little email. I was like, okay, they didn't do what they said. The bazooka that they had hidden, in their pocket, with the bulge in their pants, wasn't enough. So I covered into this because this kind of made sense, right? We talked about 134.50 as a level of support. In a few of the other charts that we posted on Chartly, the real big one was down here. So I'm like, you know what? Let me cover a little bit. Just cover a little. Okay, or actually, I'm sorry, I think I covered a lot and have a little on. And I wrote, if we're really that weak, we should not get back above this area. Like you could see from 136.20 all the way down, you could probably come back up, but then this is where you should potentially fail and roll over. So a trade through, I believe my stop was 136.35, which was like right around here, which also is somewhat of like a little downtrend type thing. That got me out, and I was fine with it. I'm like, okay, my day, I just caught a good trade. I'm not going to flip long. Pow. This was the bar that I got stopped out in. And then I said, okay, it's getting close to 11:15. Let me see what's cooking here. And I did not fade anything. I was thinking, oh, you know what? I could probably short verse this level just for a trade. Nothing too big, right? Just for a trade against 135.70, just for a scalp. Considering that I didn't short here, I didn't short here. I had a little left over. I covered there, and then lo and behold, boom. So this is where I shorted here. I added into here, and I'm like, you know what? I'm going to be short versus high. And P.S. I think into this little flag right here is where I covered, and I said, you know what? I just gave some money back. I'm not fighting this trend. I'm not going to stay with it. You saw commitment, bull flag. You had a huge move. This was the wake-up move off the lows, which you might not be able to catch. I think Sperling went long into this. I wasn't seeing it long. This is when it broke this little downtrend, showed commitment right here, pow up. This is when it flagged, and one little clue not to short. I think the VIX was also down like 5% there. So I gave it a try into this little area, into this move. I covered and said, you know what, I'm out of here. I got to go to the gym and burn, whatever. burn off some frustration, and then lo and behold, the rest of the day, a little bit more sideways, and all of a sudden, pow, market closed right up here. So not the easiest environment, if by taking out the highs here, okay, and failing, definitely was an invitation to be short. And then once we took out this low here, remember this low, people probably added to it, but recently pressing into these levels have not been good. So lo and behold, here we are, back at a pretty big level where if you just rolled up your shorts and stayed short and said, you know what, Big Ben is not helping out right now, Europe is still imploding, China's going to have the hard landing, earnings haven't been so good or so hotty-totty, a lot of you guys like that little phrase I said today, you have some decisions to make over the next few days. And there are a lot of people out there very frustrated, a lot of people with opinions, a lot of smart people that understand what's going on in the environment and know that there's a Ponzi game going on and everyone's taking from Peter to pay Paul, and at some point the run on the banks is going to really impact us here, or the fiscal cliff that's coming up after the election or before the election is going to smack us in the face. But sometimes before the world implodes, you implode because you don't have enough capital to stick with the thesis you think that you could handle long term. So for me, I don't really have a thesis. I feel like if I was just navigating the ascending channel and I turned off the TV and I turned off the media sources and I turned off all my supposedly really rich friends that have made millions and millions of dollars, and I guess at some reason they're very conservative now and all they think is they need to preserve their capital, so maybe they're a little bit more bearish than other people out there, or who knows, maybe they'll be right at some point. P.S. You look at this chart now and it's getting interesting because you go to your daily chart here. What do you have? You have a pretty big wedge now on a macro level formed, right? Here was the high that was put in the end of the first quarter. Here was the low. What was the date of this low? This low was back on June 4th. We've had a series of low, higher low, and here we are heading into a downtrend that's been controlling the tape since for I guess basically the whole second quarter. So the question is, do we trade above this, take out 137.51, and that would really cause a pretty big squeeze. Sometimes you break out and fail, which could be bearish. Sometimes you break out and go. I remember being on CNBC talking about this wedge. Okay, it was a pretty big macro wedge. Here was the high coming into your downtrend. Here was that October 4th low. Remember when I talked about that? I said 75% chance. That's the lows of the year. The lows for for a long time, whatever. P.S. low, higher low, and then once it crossed above this downtrend, look at this move. And remember, we were able to hold 15 positions, 10 positions, depending where it was. Remember that this time period we were riding the 8-day all the way up with a 10-day. Every time we touched a 20-day, things were fine. That was a fun quarter to trade around positions, hold positions, high five, everyone was happy. Anyway, lo and behold, we have another wedge from a higher level. So the only thing I don't like is that it's a summertime and a lot could happen because there's low volume, but it's, maybe there's that many people out of the market and it's just the Fed buying S&P funds, who knows, whatever it is. We break this area and you're short, you have a lot of decisions to make. If you just, come on me right now and you say, okay, Red Dog, we're taking you from the past, we're putting you in the future, look at this chart, what does this chart tell you? Don't, I was like frozen in a cocoon and I'm not allowed to know anything that's going on in the world as far as Europe, China, our own deficit, this and that. And they said, okay, take a look at this chart. What do you see? And I'd go back to the chart and I would say, what do I see here? I see us above the 8-day. I see us above the 21-day. I see us curling up a little bit. I see, us coming into a downtrend. And I would say at this point, it's hard to be super duper long, but if you're short, you could be in trouble here. It would be a tier 1 long looking for best stocks, and if we break out and go, we could break out above 137.5. You have then 140, above 140 of the highs of the year. So far, so good. And then I would say, let me take another look here and see what's going on as far as some of these Fibonacci retracements. Just use some of my trusty analytics, which I don't see on here. Maybe they're okay, I might have to do that tomorrow in the morning call. But basically, I'm sure if you go I remember from here to the high, I think all we did is pull back 50% of this move. So we literally went from the low all the way to the high. And then if you look here, what do? Nice, healthy pullback, okay? Held higher. What do we do also? We retested this old wedge here, so you didn't have to chase this excitement. You actually could have bought the dip. And there's some commitment here, and it's, heading higher. Some guys actually said to me today, too, on Twitter, they're like, Red Dog, you were on Cramer, and you said S&P 1700 by 2015. What's it going to take to get there? And I said, you know what? I think that's still very realistic. The way we're absorbing all these negative headlines, the way where we're still trending higher. You go to your weekly charts, and everyone's talking about this three peak series or whatever. But overall, you take a look like this. You have a low, a higher low, another higher low, another higher low. Here was this wedge, broke to the upside, a higher level wedge. So things are still intact. And you go here, you do have this double top that obviously was put in, but we're a lot closer to this top than we are to this bottom. And we're above the 200-day. And it does seem as if things might be discounted enough. And God forbid, things do get a little bit better. Who knows? But again, I'm talking macro. Let's talk micro. Today, Intel came out with numbers. The headlines aren't going to read good. But meanwhile, Intel came down from over 30 to 25. It was negative after hours, went positive. It's going to show you that they might have discounted some of these things enough that they could actually rally after earnings. So if you look at Intel right here, we talked about it in the morning call, if you sold it correctly on this breakout failure, or you sold it when it broke this rising trend line, and then it retested it here, you had the luxury of maybe buying it back on support. And you didn't have to take it into earnings. You could have waited for it to go. It was negative to come back up. So who knows? That's showing that Intel might be somewhat priced in, and at least it's worth a shot there. Same thing with Wynn. Wynn's been a disaster. Here was your outside day where it failed. Here was another trend that broke, that gave you another signal to get out of the way. So if you didn't do it on this outside day, you had to do it right here around 120. And down at below 100, it's trying. It still doesn't look good at all, to be honest. But people were trying to short it after hours down at 92, and from where it came from, what is this, 170 to recently as high as 140 to all the way down here. Sometimes it's all priced in. We shall see tomorrow. But again, these things have been taken down. A lot of these stocks have been taken down into what has been, what everyone's worrying about with a bad second quarter. So we'll figure that out. Today, Goldman Sachs opened up above 100, was a nice fade. Once it broke below 99, 99.5, and then it really didn't do anything until the end of the day. So we'll continue to look at these banks. These banks are giving us some mixed signals here. If you look at, right now, this is the daily chart. This daily chart still looks gross. Look at this. Remember this head and shoulders pattern that I was watching it, and I'm like, what is this telling us here? Never thought that you would really get the move, but you did get the move here. Remember this? This was as high as what? 130 down to the neckline of 110-ish. So that's 20 points from 110. What does that get you? Gets you about 90, right? So anyway, let's hope that this isn't another head and shoulders pattern where you have the left shoulder, the head, and now maybe, if we bounce up the right shoulder, because that would be 130 to 90, that would make Goldman Sachs $40. But I guess I would go with the bear thesis and the Eric Schiff thesis that 2008, we're gonna be worse than 2008, and Europe's going to implode, and that we're all going to be, eating canned food. We'll see what happens there, but I try and be a little bit more optimistic than that. But we'll see. We'll know. If Goldman Sachs breaks 90, 60, it does look like it can go low. But for right now, on the chart, it's definitely, actually, look at this little, go to the chart. Here you go, a little breakout failure, pretty ugly bar. I would say let's see how it handles this 95.74 before we worry about it breaking big support here. JP Morgan definitely didn't act well today, so it's another kind of negative sign. It's not the end of the world, but remember, we rallied on Friday based on this day of JP Morgan's decent earnings, and what happened the day after. Took back almost half of it, which you never want to see. And then today, we filled the gap, came off of it. So we'll see what happens here. You still have this trend line to trade against. It's still below the 200-day. I guess you could say it's still holding This lower range is small little uptrend, so we'll see what happens. If we start breaking below this 34, we'll know that the banks probably will be pressured again, and that's when we'll see Goldman Sachs break 95, and then we'll know maybe people care about what's going on in the banking sector. But again, if you're short JP Morgan and we start breaking above this this downtrend, there's a pretty big gap to be filled. So you have to be careful both ways. You can have high level stops and low level stops, and as we talk about that, I know Facebook was a setup that didn't work. It was a losing trade. I lost money in it, but it could have been worse. Could always be worse. You know, you step on a landmine, everyone sits on the landmine and starts having a coffee clutch, you're going to blow up. Okay, if you step on a landmine, you're like, oh, this doesn't feel right, and you get away from it. Maybe you lose a limb or a finger, but at least you're off the landmine and you're running. And that's basically what Facebook did. Facebook had a nice move. You know, then it was holding higher. We said you could anticipate it and buy it before 33.40, you know, and have tier 1 or small to be in it. But if we break 30.55 or 30.25, you're out, you know, or you could just wait for it to go. So those of you who anticipated it like I did, you know, yesterday you could have got stopped out at 30.25 before it went all the way down to 27.10 today. So yeah, you lost $1, but big friggin' deal. Okay, I'll try this trade all the time. You know, once it broke this level here, you get out of the way. If you got out of the way, some guys are even buying it versus this 27.15 and put a little like a 5-minute reversal strategy there. So guys who sold it here that might have lost $1, because remember we were trying to say, okay, if it can get above this channel here, it can get back underway. We started talking about it here, you know, failed here, red bar there. Some guys actually even cheated and got out early because it was showing some technical weakness. I had to stay in for compliance purposes to this point because that's what I said in the media. But the trade changed really on these 2 days. That's when it got weaker. And then the funny thing is just the way these algorithms are working. You would have thought that, you know, the dip buyers could have been able to come in and buy it right around here, because just remember that, you know, the first 2 strategies we had on Facebook was 1, the red dog reversal, 2, when it traded above 28.10. You know, so you would have thought it would have held it, but instead it pushed everyone out before making a tail. Didn't get back down and test the lows. But anyway, if you go to the 3-minute chart, some guys were watching a few different levels, and it became a nice trade today. You know, you go here, right? This was the move all the way down into the lows, and then it went sideways, sideways, sideways. A lot of guys were drawing this lower range. I was getting tweeted all day, like, Red Dog, you think we could try it versus 27.15? I'm like, well, if you sold it at 30.25, you could try it at 27.45 versus 27.15, and here you go. Nice igniting. You know, igniting bar right above this range. What did it do? It came right back to the prior day low, okay? And then it went sideways, gave it another push, and then it closed off. So meanwhile, it was a nice day trade if you treated it like one. Or some people got it stopped out and now they're longing again and they have 27.15 as a stop. But for me right now, this pattern is really in a void, as it's going to need more than 6 weeks. Sometimes you get like a cup and handle pattern that takes 6 weeks, but typically the most reliable take 5 to 6 months. But those are typically in stocks that have been public for, you know, 5 to 10 years. This has only been public, you know, for almost 2 months. Anyway, just a scalp now. I wouldn't be married to it. As far as gold, guys are saying to look at it today. Gold really didn't do anything today. Even with Big Ben speaking, it's kind of been out of play. Here's your small little, you know, downtrend there. You have a bigger downtrend coming in right here. It's still holding macro support. I have not traded this thing in 2 weeks, and I'm very happy. Last time I tried it, it was right around here, and it hurt. So I'm just going to wait. Either it's going to break out with huge, huge volume, I'm going to go after it, or it's going to break down with huge, huge volume, and then I'll go after it. But in this area when there's no volume and no commitment, I'm staying away. And you know, there's some things we can control and some things we can't. And it feels like everyone's saying the market's defying logic right now. You know, Mr. Market likes to make as many people feel as uncomfortable as possible, and there are not a lot of people long this tape. And as I said before, I'm talking to the biggest funds out there. A lot of them are short. A lot of them love gold. And short is not working and gold is not working. So these are the guys that are supposed to be, you know, the smart guys. But you have these vanilla mutual funds that don't think too much and just keep putting money to work in S&P 500s every single month, where there's a lot of flows. And it's going into there. It's getting allocated to these S&P stocks. You're seeing a lot of big name mega cap stocks that are acting well, whether it's Walmart, Target, today it was Disney. You have a lot of these mega cap stocks that have been basing for almost a decade, making nice moves, and that's supporting the S&P. Whereas high beta and some of these other groups may not be, but you have to realize that. Like, look at Disney today. What did Disney do? Pow. No bear market in Disney right now, right? New highs. You could be a stock picker. You could be making a lot of money riding this trend in Disney. Disney, wow, look at that. Good job, Disney. You could, you don't hate the market if you're an investor in Disney. If you're an investor in Walmart, you don't hate the market here either. You might have hated the market if you were in this monthly channel and pulling your hair out for a decade, but that shows you how you have to time things. And this is why, again, it was my retail stock of the year as it crossed, 62? Now you're at 75. If you're in Target, you don't hate the stock market. You look at this daily chart, it's coming up. It still actually could break above the 70. You go to the daily here, it was downgraded, took it in stride. Little mini red dog reversal yesterday, downgraded, and that was buyable today. Visa also, you don't hate the market. So what I'm trying to tell you is this. There are a few things. People are always like, what's your plan, Red Dog? I'm a professional trader, and I'm also the offensive coordinator of a big community that I throw ideas out there all day long that I don't necessarily have to run the routes for. All right, long term, got a macro equity plan. Okay, me and my wife, we're married. We put money every single month. I like to do an S&P 500 fund. I know it didn't really work for the baby boomers. It didn't work over the last 10 years or 15 years, but I do think if you're in your 30s and 40s, you could put money away every single month in an S&P 500 fund, some in overseas if you want to be a little crafty, and now maybe you buy China. You buy the big caps of China and start there since it's probably been beat up enough if you have a 5-10 year plan. Same thing with India. I think that's fine. So, you don't have to be a stock. I'm saying there's a macro plan where you don't have to be a stock picker. You could just do it every single month, and then I bet you, what am I? I'm going to be 40 actually. I'm going to be 40. Jeez. In September. In 15 years from now, I have a feeling there's going to be a lot of money in there, or more than that. Same way my son is for a 529 plan. By the time he's 16, 17, I have a feeling by putting money away in that kind of plan, it's going to make money. So that's one way to approach the market with a macro plan. So if you have macro money in the market and you see the market trending higher, you're actually happy, and so is the world, okay? If you're, another step further, where if you're a stock picker, which you can be, but you have to be educated, you have to be attuned to the market, you have to read Investors Business Daily, you have to watch us here, you have to take the active trading course, you have to do a lot of things. You could find, winners, like a Walmart, like a Disney, like an Apple, like all these stocks that if you have been in them for 5-10 years, and you could make a lot of money and a much more alpha. But then also you could be more of an intermediate trend trader, which is what I am, and I tend to say where I'm not holding major portfolios, I'm looking to trade the trends of the market, whereas first quarter was holding 10 to 15 positions, trading around them, letting the market make me money. Second quarter was more of a sniper approach, pick and choose your spots. And now we're at an inflection point where first quarter you were a buy and holder for an intermediate trend. Second quarter, get short, remember the head and shoulders top, and then get long with the head and shoulders bottom. And now we're getting to that point where, okay, which way are we going to go? Third quarter is going to be different, and so is the fourth. So for me, I'm trying to approach it that way with my 400 associated members, with my community of tens of thousands. So this way, you could figure out where you want to be. If you have a macro approach with like a 401k that you put in monthly that you're going to turn around in 20 years and do well with, whether you want to have 5-6 stocks like an IBD approach where you're not a mutual fund in your IRA or whatever, but you're picking stocks like an Apple or things that over time, like we talked about Dunkin', I do think Dunkin' could be held for a long period of time. You got a little bit of Starbucks, a little bit of McDonald's there. Or you could also then be an active trader where you're doing things for 1 to 2 days, trying to make 50, 60 cents, add some cash flow, but you're more of a professional. So you got to figure out where you want to be, how you want to do it, how much time you want to allocate, and what makes you tick and what kind of resources you have. I'm not going to tell my dad right now, who's 67 years old, start putting monthly money away into an S&P fund. No, he had his chance, so I'm just saying there's definitely age barriers but that's also based on your life. And if you're uncomfortable and you can't pay your mortgage payment, you should not be watching this because you shouldn't be trading for cash flow. You should be paying your mortgage, unless, you think that you can live there mortgage free and that they're not going to foreclose on you. But one day that padlock will come. Same way one day the ramifications of Europe might actually, get fulfilled. But anyway, I've been rambling. I think that's because I just drank my Starbucks coffee. and just trying to tell it like it is. Not easy. We had a reversal, then we had another reversal, and after we reversed, Apple got a little weaker, Goldman didn't go, some things diverged. So it's not a tape to sink your teeth in. It's not a tape to be all in. There's some people out there that are all in. I don't think you should be either all in, long or short. You should be tactical. Be involved, make a little bit of money, enjoy your summer, and keep moving forward and keep making, taking strides to better your strategic tool belt. That's it. Scott Riley, T3 Live. See you tomorrow morning at the morning call. Have a good night.